Hey, everybody, and welcome to another episode of UnWoke Academy. I'm Jonathan Broadbent, your host. I want to introduce you today to Yosemite Sam. That's a name selected by somebody who's come into us via the PMA, and ultimately the question boils down to, how woke am I? A lot of people are asking that question. They're watching UnWoke, they're seeing all the news like the 21 different states' attorneys general, the Secretary of State of the state of Indiana, various unions and organizations that are suing for the use of the wokadoodle stuff like environmental, social, and governance, diversity, equity, and inclusion in things like your 401k plan and portfolio. Yosemite Sam showed up and has shared with us a series of different statements from many different types of accounts. What you're looking at right now is a 401k statement. As promised, all the vital information is all blanked out so that Yosemite Sam remains anonymous. You may recognize this, or it may look similar to a 401k statement that you might get if you are so fortunate as to have an employer who offers a 401k. Let's drill down and see what we find in this 401k plan. Looking at page 1 here, we see a lot of the usual suspects. You can see a lot of Vanguard American funds, which, in case you didn't know, used to be the largest mutual fund company in the world. They've been usurped many years ago by BlackRock, Vanguard, and some companies like it, but are still a very large issuer of mutual funds. So we've got a collection of different names here in different sounding investments. So this is the sort of thing that most everybody is faced with when signing up for a 401k plan. Which one is right for you and which combination is the best fit for you to have a diverse portfolio, or you might hope for a diverse portfolio. As you can see, we've blacked out the pertinent information, or actually I selected blue boxes because you can see where I'm headed with that. All of the stuff that we're going to find here leans heavily left, which is represented in the United States by the color blue. Let's take a look at these things. We've got Victory Core Plus International Bond. We've got a large cap S&P 500 index that's actually issued by Principal Global Investors, and some Vanguard, more Principal, more Vanguard. When you're buying a mutual fund, that is not in and of itself an investment. That is simply a company that you're giving the rights and authorization to build a portfolio and manage investments for you. So what are the actual investments? What are the companies you're buying? Let me put that a different way. If you're the type of person over the last couple of years who's been frustrated by the corporate behaviors of things like Target, Anheuser-Busch, which is the parent company of Bud Light, John Deere Tractor, maybe Harley Davidson, and maybe you're not sure about the corporate behaviors of those companies, and you're thinking to yourself, or you should be, maybe I don't want to be invested in those companies, especially if they're companies that have run up significantly in value. For instance, Alphabet Company, which is the parent company of Google. You've got Meta, which is the parent of Facebook, and lots of those big companies, Apple, Microsoft, etc. So maybe you're the type of person who's thinking you don't want to invest in a company when that company's stock price is meteorically, astronomically sky high, because that represents a time of great risk to anybody invested in those companies. Let's drill down and see what these mutual funds are actually invested in. I'm going to break one of my usual rules here and give you the punchline first. As you can see, the tabs on the bottom, what we've done here is created a spreadsheet for each of the different accounts. The 401k is one of the accounts. And we can see in here, we're going to get in a moment to the 401k and what we found in each of those holdings, each of those mutual funds. And in a second, I'm going to show you exactly how I did this. So anybody like me out there who's interested in using websites, creating spreadsheets and tracking this stuff, or even you don't even have to create a spreadsheet. If you're just remotely curious and have 3 minutes of spare time, grab your 401k statement, and I'm going to show you how to do and look up exactly what we've got here. So I am going to get back to the 401k, but let's cut to the chase here and show you one of the results that we found. Of the different investments, and we've got an investment account, we've got a rollover IRA, we've got a Roth IRA, and so there are all kinds of different investments that are being made for this individual by supposed financial professionals, and the result is a vast number of different mutual funds and exchange traded funds. If you've watched this program before, you'll remember exchange traded funds, or if you're not familiar with them, think of them as kind of a cousin to mutual funds. They work in very similar fashion. But the net result, and I'm going to zoom in so that you can't miss this, the net result is a massive amount of redundancy. All these different sounding mutual funds. And remember, this is the combination of all these different investments and types of accounts. So this is not just the 401k. We're going to get to that and drill down in just a moment. But the combination of all the different investment accounts that were shared with us in statements is, remember, Alphabet and Company. Remember that redundancy that I showed you? All those different sounding mutual funds, all investing in effectively the same thing. This Alphabet Company shows up 29 times. 29 of the different investments that this person is being put into all have that in common. They're all investing as one of the primary investments in that mutual fund in Alphabet. So maybe you own 40 different mutual funds and lots of different types of accounts, but if 29 of them are virtually identical, here's the same thing, Amazon.com, and that's 14 instances of that. 18 of the investments are invested in Apple. Broadcom is 9. And again, so you can see here, 22 of them invested in Microsoft. So what are these scores right here? You're going to love this part. I've been talking about this for a couple of months now, since we discovered and became friends with the folks over at Inspire Advisors. Yes, that's Matt and Drew. And they have a tool. It's publicly available. I'm going to pause here and show you in a moment what this tool looks like. You can log in, use your website, use your phone, use any browser, and you can look up the corporate behaviors of any of these types of companies, and you can make informed, educated decisions about whether or not you want to do business with them. And that includes whether or not you feel like being invested in these companies. So what are these numbers? This negative 100, by the way, here's a hint. That's actually the worst score you can get. The positive numbers are pretty good. We're going to get back to that spreadsheet where we drill down into the 401k and other types of investment accounts in just a moment. But I want to pause here and show you Inspire Insight. This is the super awesome, super easy to use, wonderful tool that is designed and developed. It's publicly available. You too can open up a browser and go to Inspire Insight. I'll include the link. It's inspireinsight.com. It's super easy. Inspire Insight. You can see the name up there. When you get to this page, well, first of all, the brilliant minds over at Inspire Advisors created this, and they've put up here a number of the typical usual suspects. So you can see in here Google, Johnson & Johnson, Alphabet, Pfizer and Company, Steris, etc. So you can see a mix of what makes good companies. And again, this is based upon the corporate behaviors of these companies. So you can decide for yourself, in addition to whether or not you might want to shop there and spend your money there, you can make informed decisions about whether or not to invest your money there as well. How does this work? You can go up here and let's say that you were considering buying some sporting goods. And there's a company out there called Dick's Sporting Goods. Let's look them up. Before you head on over to Dick's, you can type in Dick's Sporting Goods. It pops up right here. You can see the score. When you click on it, you're going to see the negative 72 that Dick's Sporting Goods, I just picked them because they were kind of front of mind for me. And you can drill down and you can actually open up and read about the negativity, the negative scores that are here. You can do that with airlines, with coffee companies, grocery store chains, all kinds of stuff. You can find out about the corporate positions, corporate behaviors. This is a Judeo-Christian metric that is there and easy to ascertain. You can make a determination of whether or not these companies meet your value system, if you approve of them. And what I say is, if you're investing for retirement, why not vote your values and have some things in your portfolio, or have a portfolio comprised of investments that you can feel proud to own? In similar fashion, you can drill down on the companies that have good scores, and you can see what they're doing that is earning them good scores. So what a super cool, amazing tool. It's all free. It's all publicly available. Go in there sometimes. Add it to your phone. Add it to a browser. By the way, I'm personally not a fan of the woke tracking browsers. I like Brave. That's what you're looking at here, but any browser will do. You can open up Inspire Insight and see what's happening underneath the hood of things like mutual funds in your investment portfolio. Right. So back to Yosemite Sam. Here's the composition, and now you can see where these negative scores came from. The Alphabet company, the Visa, etc. These are companies that have, and you, if you're curious about what made them negative, you now can drill down and see exactly where these numbers came from, and you can research on your own. You can look into Inspire Insight. They are a brilliant resource. I suggest using them. Get in the habit of using them often. If you're spending money, what I say is, why give your money to the people who hate us? If they don't value Western civilization and the freedoms, rights, individual personal autonomy, and the liberties that we have here in the West and specifically in the United States, why fund them? Why give them money? Here's an example. Meta Platforms, that's Facebook. Facebook, in case you're unaware, is in the process right now of just crushing free speech. They are vilifying and outright banishing and attacking anybody with a conservative value system. Why would you fund them? Personally, I've been migrating off of them. I do still have some things that I have to go to on Facebook, so you may find me there occasionally, but I don't spend much time there. I call it Facebook the East Berlin of social media platforms. Why give them your money as you're saving for retirement? By the way, I've said it before and I'm going to keep saying it. There's great data to show that the investment managers out there who didn't go woke, their investment performance is actually better. They're avoiding some of the companies that are creating both massive spikes and balloons in the marketplace. They're huge bubbles that I think are ready to pop, but they're also avoiding the pitfalls of these wokadoodle far left companies. Now let's start with the 401k. So remember the 401k statement that I brought up. This is super easy. I know it looks like a bunch of numbers and stuff like that, but this is super easy. Follow me on this. If you get stuck at any point, just backtrack, go back a step, and then follow along with. Reverse this, hit back, rewind a couple of times. If it whatever it takes, I think once you get it and see what this is, you'll recognize how super simple and easy this is. Each one of these is one of the investment options that's inside the 401k plan. So here's Yosemite Sam's 401k holdings breakdown, and we want to see how woke the portfolio is, in addition to seeing how many duplicates there are. So here's that principal large cap S&P 500. These are the top 10 holdings inside of that mutual fund. These are not the total holdings of each mutual fund, but these are the top 10 of each because that's what's reported publicly. So you can see the composition here, and you can see, again, here's those numbers that come from Inspire Insight. You can look them up yourself, verify, and see what you find in the investments that are actually being made on your behalf inside your IRA, your 401k, your brokerage account, your kids' college savings plan, whatever it is. You should be able to drill down and find the same sorts of information and figure out what's happening under the hood. And by the way, if you are listening to this, if you are a listener to unwoke.academy, send us your info. We want to drill down, we want to do as many of these as possible. And at some point, I'm actually planning on targeting some companies that are large, they're publicly known, and they're not connected with anybody who has approached us. And I'm going to start publicly disclosing what I'm able to discern from the investment pool. So far, all the stuff that we've got has come to us with the request from an individual that we look into them. Under those circumstances, those individuals stay anonymous. We can't mention the name of the company or the individual. That's just how we roll. If we go out there and find a large company on public database and are able to drill down and pull this information, we're going to report on it, and we're going to publicly name the company and the holdings because all of that is actually public information. So here's what we've got in that first basket of the top 10 holdings of principal large cap S&P 500. We have this combination of investments. Look familiar? If you watched that episode a few days ago where we pulled from some of the top 100 mutual funds in 401k plans, it looked awfully similar to this composition, didn't it? Moving on to the Vanguard Growth Index. Well, gosh, isn't that funny? It looks awfully similar to this one, doesn't it? Well, we've got a mid cap that sort of breaks the monotony a little bit. And actually, we have some of these companies. I would suggest that true constitutional conservative Judeo-Christian patriot types would probably be interested in holding. Some maybe not so much, but this one's not entirely terrible. But at a certain point, why wouldn't individuals look at these companies individually and stop paying the ongoing annual maintenance fee to give money to somebody who's going to invest them in woke? But that's my opinion. I'll get back to brokerage accounts and how they work in a moment. Drilling down, here's another one. We've got the American Fund's New Perspective. Isn't that a cool sounding name? It's New Perspective. What's new about this? Here's the top 10 holdings. Well, there's a new player that shows up here, Vertex Pharma. I do see it in some other funds, but it's not as common, but mostly these are the same players over and over again. Now we've got the Vanguard Emerging Markets. Emerging markets really just means small countries outside the United States that are developing nations. So, of course, there we're not going to find those globalist mega companies, but there are some that to me are very familiar, and I see that they are recurring players in the international investment space. By the way, and I'm not suggesting that any of these are necessarily bad, but keep in mind as we're investing internationally, the implications of those investments. And I'm talking specifically about the interview we did with Justin Bernier from the National Security Index. That was back in, I believe, May of this year. You may want to backtrack to that one where we talk about the practice of using offshore managers to funnel US investment dollars through offshore managers and into funding the Chinese Communist Party and their military ambitions, among other bad things. Maybe, arguably, even worse than the wokadoodle companies that you probably don't want to fund. I'm pretty sure, I'm guessing, if you're listening to this program, you don't want your money being used to fund the growth of the ambitious military expansion of the Chinese Communist Party. I'm just guessing that. Moving over to Yosemite's personal investment account, this is a part of a portfolio that's invested on behalf of Yosemite by financial professionals. So there is a group of people that make recommendations to Yosemite on at least 4 different accounts. We can see them down here. There's 2 individual accounts. We've got a Roth IRA and a rollover IRA. This is pretty typical of investors and families. When you grow and over the years you move from job to job, you might have a rollover. At some point, you get interested in funding a Roth IRA. You might have, as Yosemite has, you might have a 401k through your workplace. You might and get some money from an inheritance or selling something of value. You name it. There are different types of accounts. So let's drill down and see how those people are managing the money, or what recommendations, I should say, are being made to Yosemite. You can see a list of the different mutual funds and exchange traded funds that Yosemite is being put into by this investment house. So they are charging a fee in order to put Yosemite into mutual funds that have a fee of their own and some exchange traded funds. So again, in each one, we can drill down and see what the top 10 holdings are in each of those mutual funds or exchange traded funds. Same thing. It looks very similar. So the statement copy that comes for each of these, and these were shared with us by Yosemite when he and his family came to us and asked, how woke am I? We can see on the statement the different mutual funds, the exchange traded funds, how much is being invested. And don't pay too much attention to this ticker symbol. This is something that folks like I use, people who are financial professionals and people that do market research. You might find that some of these mutual funds, or typically will find actually, that many have multiple different ticker symbols. What that refers to is a share class. There are different share classes that are offered of many of the mutual funds out there. It really depends a lot on where and how you're purchasing the mutual fund, but ultimately what that changes, even if you have This is the Calvert Equity Fund, and this is the ticker symbol that this investor, Yosemite Sam, is purchasing. What that indicates to me, and what you might look for if you're very curious about what your fees ultimately are, is you can extrapolate, or actually you can pull from websites, the fee that's associated with that. These are the management fees of each of these different mutual funds. So each one will have a little management fee attached to it, and you can see the money that's being collected and paid to this manager. That is typically on top of and separate from the fee that's being collected by the investment house. So you know what this number means, you know where we get it, and you now too can go to Inspire Insight, pull these numbers and do some of your own research. You can double check the things that I'm coming up with here. But what I'm seeing is that Yosemite Sam is being invested in things that are overwhelmingly far left woke. You can see the red numbers, but also, in addition to seeing the duplication of investments, as I said before, we also want to see the composition and how left-leaning wokadoodle effectively they are. Looking at these, we have some really different sounding names, and you might even recognize some of these investment managers. Calvert Equity Fund. Here's the Federated Hermes MDT All Cap Core. And we've got the JP Morgan Hedged Equity 2. But there's the interesting thing. Not seeing a lot of difference between all these different types of investments. So this again goes back to what I've been pointing out for weeks now, and I keep seeing the same recurring pattern over and over and over again of many of these managers allowing themselves to be steered into a very small basket of already overpriced, overvalued investments. I don't like that on a number of fronts. It not only creates and puts more money into a bubble, potentially harming, and potentially jeopardizing mass numbers of investors who are unaware of what's happening under the hood in their mutual funds, but it also takes money away from small business and developing other alternative companies that are not part of that woke sort of globalist cabal of big names like Apple, Microsoft, Nvidia, Amazon. These are all just a collection of the usual culprits that right now, at this moment in time, are being vastly overfunded. They're doing that. They're overfunding those companies to the detriment of other companies that could receive positive funding. Some of these are not terrible. We start to get into international growth, but again, remember, in international growth, we want to be cautious and sort of try to stay aware of the potential some of our money could be used in a time of war to fund not only our enemies, but the wartime apparatus. And here's another one. This sounds really great. I mean, it's got a cool ring to it. This is what's called an exchange traded fund. This is the Invesco QQQ Trailing Unit Series 1, but look at the investments. I'm really not seeing the difference there. Here's another one. BlackRock iShares Core S&P 500. Same thing again. Here's another one. Vanguard Scottsdale Russell 1000 Growth. Doesn't that sound great? But what are they invested in? Pretty much same things over and over again. And now we have a small cap. Small cap is where you kind of break ranks with that recurring theme of investments over and over and over again. It is a different marketplace. I don't suggest a lot of time and energy spent in small cap. There are great opportunities there, but I encourage a little bit of caution because many of those are companies that are not yet established. If you're looking at small cap, and especially even more so micro cap, there's additional research and some due diligence that's required. But then again, where we would expect the due diligence to be done on behalf of investors, and it's much easier to do in the large and mega cap, it seems to me that it's not being done, and it's not being done effectively or efficiently or really blindly at all, because there's so much money being funneled into such a small group of globalist international companies. Here's Yosemite's rollover IRA. Noticing a theme here? Here are the top 10 holdings. Here we have the Calvert Equity Fund. Doesn't that sound familiar? Didn't we have that in this one as well? Yep, Calvert Equity Fund. That's one of the things I look for is recurring mutual fund investment and, of course, the recurring underlying investments as well. Inside of the rollover IRA, we've got very similar looking stuff. Look at the composition of these investments. Overwhelmingly far left and a lot of duplicates. Here we are, same thing. We've got a slightly different one. This one is the Invesco trailing to NASDAQ 100. Cool ring to it, huh? But then look at the underlying investments. These are the top 10 holdings. Same thing. BlackRock iShares Core S&P 500. Here's the BlackRock iShares trailing MSCI US quality. That is, I'm not sure how we're defining quality. It looks like sameness to me. These are the kinds of things that it really pays to drill down and understand about the underlying investments in any portfolio. Now, looking at the Roth IRA, do we find any difference here? Nope, same things. It's the same things over again. So what we have here is these 4 accounts, not the 401k, but these 4 investment accounts are all being managed by one investment house. That investment house is making mutual fund and exchange traded fund recommendations. And in each of these different accounts, they're nearly identical, very similar composition of mutual funds and exchange traded funds. And when we drill down one layer further and look inside of the mutual funds and exchange traded funds, we're finding a tremendous amount of similarity and overlap. That results in this. That's how we end up with 29 different mutual funds and exchange traded funds all invested in Alphabet Company. And we end up with 22 different mutual fund and exchange traded funds all invested in Microsoft. So the net result is not only is Yosemite Sam invested in woke far left companies, causes, and countries, but he's also being invested and his family is being put into investments that are drastically inflated in share price and valuation right now. And also, he's far less diversified than you would think by looking at the portfolio. Because when you look at it, you get these statements and you see a vast array of very different sounding names. These are problems. This is what we want to drill down and fix. And we want to get this family appropriately diversified and into less woke or unwoke investments. As promised, I keep telling you guys what I do to create these episodes and to do this research is use publicly available information. So you too, anybody with a smartphone or web browser, computer, laptop, tablet, or otherwise, is able to recreate these steps and do exactly what I'm doing, drill down and look at the same things I'm looking at, or grab your statement and do it for yourself. The next question to answer is, where does this information come from? How do you know what the top 10 holdings are in any given mutual fund? Well, it's super easy. You probably heard of Morningstar. If you haven't, it is generally a household name. Lots of people rely on Morningstar for all sorts of financial data. There are other companies out there. You can use Yahoo Finance or MSNBC Money and all kinds of things. I landed on Morningstar because, in my view, I think it's probably the most commonly known and referred to as a kind of a household name. Whichever one you use, it's super easy. Remember that each of these mutual funds, if your statement doesn't have a ticker symbol, no worries, just enter in the browser, in whatever browser you use, enter in the search field the name of the mutual fund. If you don't have the ticker, enter Calvert Equity Fund. Remember again, none of these are investment recommendations. This video is not made to recommend buy or sell instructions for anybody. This is simply an instructional video on how to figure out how left or right and what the leanings of the composition of your portfolio are. But once you get to Morningstar or whichever your preference, let's say you do have the ticker symbol. All you're going to need to do in this one is enter CEYIX. CEYIX. When you enter CEYIX, you're going to see Calvert Equity and all kinds of detail. Again, you can do it with lots of different browsers, lots of different search fields in the world of finance, like Yahoo Finance and others. Whichever one you're using, you should very quickly get to what's called the expense ratio. The expense ratio is the fee. That's the fee that you pay every year. Notice here, we have the expense ratio. That's where this came from. So I'm actually just simply using the data that's publicly available on Morningstar. Now, when you tap on the portfolio button, it's going to change the data that's being given to you on Calvert Equity. And when you scroll down a little bit, there we are. We've got the composition of these top 10 holdings of this mutual fund. This fund holds these as of the most recent publicly available data for what they're invested in. So there it is, ladies and gentlemen. This is the composition. Anybody can do it. When you get your statement, all it takes is a few mouse clicks, maybe 5 letters. Enter in the search bar. But again, I'm going to do it a little bit differently. Let's say that we have a statement that says the Federated Hermes MDT all cap core, but we don't have a ticker symbol. No worries. I have a little keyboard shortcut here for the purposes of this video. I am going to Control C, which copies, and I'm going to Control V. And when I type that in there, Federated Hermes MDT all cap core, it's going to show me information on the Federated Hermes MDT all cap core. You may need to know the share class. Remember, I was talking earlier about the different ticker symbols. They may have different share classes. I wouldn't spend too much time worrying about that if it's not easily apparent. Mostly what we're looking for here is the composition of investments. That's not going to change between these different share classes. You're going to find the same top 10 holdings no matter which one of these you click on. If you are able to determine that you're an investment vehicle, like a 401k, typically have R6 share class, click on that, and you will not only figure out what your expense ratio is, that, remember again, that's your management fee. You're paying that in order for them to manage and make the investment decisions for you. But when you drill down on portfolio, again, you can see where we got that data from. This is where we get the data that goes in over here. So between the statement copies that we got, Morningstar.com, which is publicly available website for all kinds of financial research, and the good fine folks over at Inspire Insight, Inspire Advisors, who created this publicly available tool that any of us can use to look up the woke nature. Again, that's my term, not theirs. I don't believe any of them call it woke. I do. You can look up the leanings of the corporate behavior of any of these companies. Then you can make better informed decisions about the composition of your investments. If you are not the research type, you don't want to go through all of this, but you are concerned that your money may be steered into far left wokadoodle countries, causes, and companies, then call Matt and Drew, head on over to Inspire Advisors. They will create a free impact report for you that's going to show the impact of your portfolio. If you fit with them, if you end up gelling, great, we love that. You will end up happy. I believe that they will take excellent care of you as financial planners, and you are doing a greater good as well because some amount of the earning, the revenue from that relationship comes back to fund and sponsor more work and research like this episode of UnWoke Academy. So here's the thing that's really interesting, kind of gets me about the composition of this and the way that investors have sort of been steered these days. Yosemite Sam is a pretty typical investor. Has actually done a great job of saving and capturing rollover money from previous employers, etc. So this is a pretty nice investment portfolio. Well, let's kind of flash back to years past, yesteryear, as they say, and I'm old enough to remember when this stuff happened. I'm not that old. Thank you very much. But back in my childhood, and certainly my parents and our grandparents' era, there were people that had stock portfolios. They didn't pay a group to pick mutual funds to then pick different stocks. And so I think actually society was kind of oversold on this notion that the brokerage fees were exorbitant and there's just too much money paid for stockbroker, and that we should do away with stockbrokers. They're mostly gone. The stockbrokers have kind of evaporated, and there are not many left. I actually worked at a place years ago that was a whole array of really successful, very skilled and accomplished stockbrokers. I was not one of them. I was on the institutional side, but I knew them, and we integrated and did work together, etc. But I really admired the amount of work that they did in researching the companies that they would then invest and suggest to their clients. But here's the vast, striking, jaw-dropping juxtaposition of what this represents and what used to be when people had their own portfolio of investments, of actual investments. I am absolutely suggesting that anybody and everybody out there should consider building a portfolio of stocks that you actually know what you own, instead of a mutual fund where you're giving the responsibility and instruction to trade on your behalf to some twice removed investment professional who is, they could go woke. Maybe they're not woke now, but maybe the next manager that comes along, they take over the portfolio and maybe they go woke. But the thing is, you don't have actual sight of what they're buying and selling for you. And as we see here, many of them are duplicating each other. They're nearly identical, even though they have very different sounding names. And you're paying a big ongoing fee. So what we found in the case of Yosemite Sam, follow me on the math here, it's actually pretty easy. I'm ballparking based on the composition of different investments that I see in the fees and what I anticipate is probably charged by that investment house to pick the mutual funds. They're probably paying in the neighborhood of about $10,000 per year for all of that stuff. Between the investment house and these different mutual funds and exchange traded funds and their fees, I'm saying probably around $10,000. Well, here's the thing. Most of the platforms where you can build and amass a portfolio of different stocks, most of them offer discounted trade services because they do such volume of trading now, they can afford to come down. When I was young and starting off in the business, you might see stock trades that might be $35 or $50, it might be $75, and that gets expensive fairly quickly. But now you're talking about what, $5 fees? So how many stock trades can you do during the course of a year for $10,000? It's pretty easy math. That's actually 2,000 stock trades. I don't know anybody that does 2,000 stock trades, or if I do, they haven't shared that information with me. That is that is an aggressive, probably a very active professional day trader or something. Very, very few people get anywhere near that. And that's your sort of cost benefit analysis in a nutshell, using Yosemite Sam as an example. So Yosemite Sam could very easily build a stock portfolio, and at all times, without question, unfailingly, Yosemite Sam always knows what he owns. There's no mystery. And let's face it, in these, I'm showing you the top 10 holdings. I actually don't know, and it's very challenging for even a financial professional to figure out what the actual rest of the composition of these are. It's a mystery. It could be large allocations, maybe the 11th largest investment in some of these. It might be in something that you absolutely despise. It's possible. And maybe they lean very far left and you view them as harmful to society. It's possible. It's really difficult to find out. Why go through that? Why suffer the redundancy? Why pay the ongoing fee every year for management to pay somebody to manage money for you who is steering you into investments that you don't like, that are clearly left leaning overwhelmingly, and get such duplicity? As I showed in this, you got redundant holdings. 29 times Yosemite Sam is being invested into Alphabet. So seeing all kinds of different names and lots of different mutual funds and exchange traded funds, but ultimately, if many of them are 29 or 22, 19, 18, if they're investing in these companies over and over and over again, he's paying significant fees not to be properly diversified and to be exposed to what I argue is an exaggerated bubble. This, my friends, has been a case study on Yosemite Sam's investment portfolio. Pretty soon, we're going to have a follow-up to this one showing you how we steered Yosemite Sam into a less woke or unwoke investment portfolio, where he and his family went, how they're invested, and how we got rid of the wokeadoodle in his portfolio. I'm Jonathan Broadbent. This has been another episode of UnWoke Academy. Thanks for listening.